What is going on, guys? Welcome back to another video, and this is a video that I should have done a little while ago, and I think we need to make it in different wording and how to explain to people why you're doing it and why you would do it versus buying another house and things like that. And I want to explain to you why I do it rather than buying more real estate and things like that. So with that being said, let's go on ahead and cue the intro. I've been getting dirty money. Hey guys, thank you for watching this video. Don't forget to hit that thumbs up and subscribe. I'm putting out at least one video a week, giving you guys absolutely free content that's gonna help you guys, whether it's long term, short term, just in finance and everything like that. So with that being said, let's jump back to the video. Okay, guys, everybody loves cash flow. If you don't love cash flow, you're not an income person then, and that's okay. Maybe you will just keep looking for the long term, and that's 100% okay. But I like to build my long term and be able to cash flow it. And you're probably going, how? How would somebody even do that? Well, that's what I'm here to talk to you about. And Warren Buffett does this. A lot of iconic people do this. And this is something that I was missing for the longest time in my long-term account. I bought Apple at a really, really good price. I bought Microsoft at a really, really good price. It pretty much doubled on me in the next 4 years. I was super happy. I was getting dividends and things like that. But I actually missed out on about 4 years worth of extra income that I could have had from them. Now you're probably going, oh, I own some Apple, I own all these stocks. How could I do that as well? Well, so there's a couple ways. There's two real ways to do it. Either you're going to own 100 shares of the stock, or you are going to find another stock that does the exact same thing without you having to do it. And a lot of you guys may want to just do it that way. Now, I'm going to talk about the downfalls of having somebody else do that for you. So the first one I want to do is we're going to get rid of this right here because that's going to be important here in a minute. But first of all, let's go to something like a QYLD. QYLD, you can see this stock just continues to go down. This is on a 4-hour chart. Let's go to a 3-year weekly. You can see it started, and again, it averages around 22, 23 bucks. I think if you can buy it around 20s, low 20s, I'm not 24, 18 is the high, so I'm talking real low 20s, 21, 22, 23 max seems to be that median there. May not be a bad buy, but right now you're at 17, almost $18 a share. Me? Yeah, I've been picking up some of these shares. Me and my friend actually just got done talking about this the other day, is why wouldn't we be picking up more shares during the COVID thing? You guys see what has happened and everything. It only came down to right here in the 1720s. It's gotten lower. The lowest it's ever hit is $17.01. So basically $17, and I'm buying off the lows, and I'm getting, like, this month's was 17. I think the average dividend per month, it does fluctuate again because they are selling covered calls on Apple, Microsoft, all those companies as well that we all love. I think they were talking the average, what we looked at it was like 18.5 cents. This month was like 17.5. But in past months we've had 22 cents, we've had 23 cents. 1 month they got, because they hold all that income, basically the extra income, then at the end of the year, November, they give you a big dividend, which was like 45 cents, I think it was, this past year, which was absolutely fantastic. And again, yes, I'm going to own some of these on top of the income that I'm going to get from the other ones. So like me, I do own the other ones. So we're going to bring this back up, and we're going to go, because you're not going to be able to do this on this stock, we're going to go to something like a DraftKings. I think this is the perfect example. And you guys can see I bought it in here at 14.07. I marked this because I bought it in my Robinhood account, actually. Yes, you guys can do this exact same strategy on Robinhood. I actually am going to prefer you to go to Robinhood to do it just because it's easy. It is very, very simple, and I think you should. So I'm going to move this around here on my own screen so I can see it. So if we bought $14.07 and say we wanted like a monthly dividend, except for DraftKings isn't going to pay that, but quarterly. So I'm going to go out a month out. I say 30 days, closest you can get to 30 days. I'm going to say 33, just because I want it a little bit out and I want to stay in the weeklies here. Well, what I'm going to do is I'm going to figure out what way do I want it to go. And here's the nice thing. Even if it goes against you on these, you can roll out as an option, or you can just let it get assigned and sell your shares for a profit of wherever you're at. So me, I like doing it as a covered call. So I will buy it, and I think it has been slowly going down, and the whole market's downtrending. So I'm going to go on ahead and sell something up in here. Now again, DraftKings does not move the most, as you can see here. We'll move to a 1-day chart. You can see it's not moving a ton. It got down to $10 and then bounced back up, and I'm about break even overall on it. But what you guys don't see is for the past month, I think month and a half actually. We've done it twice now. We've been selling calls on these. So, and no, I'm not selling a $14 call. You can see the probability here. You can see it over here on the right side of these percentages. Probability of going in the money. And same over here. So I find one that I'm happy with, and it's at $18.50 here. I'll sell that. I'll sell that for $25. That's like getting a $25 dividend right there. And it's got to go to $18 in order. So it's got to get all the way. It's got to get above this line right here for them to collect that. And either way, I still get to keep my money, and I make the difference from, make sure you guys can all see this. So the reason why I'm saying this is because it's right here, so you guys can see it's got to move all the way up here. So it's got to be the difference between here to there. It's got to move that much in the next month or 33 days for them to make money. And even if it does continue to move up, I'm not worried about it, because the options have a thing called theta. And again, we can get out of it. And again, this is what I teach my students. If you're buying shares, whether you're trading options, futures, whatever the case, making some money, keep buying shares. Keep building equity. Equity, 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 guys. It is by far the most important thing to have in all of these. So again, we're going to pop open this here. I'm going to move this. My bad. Holy cow. Grab the wrong screen. But it's not going to let me grab the other one. That's okay. So you guys can see that over there. You guys can choose other ones. Say you want to hold this one to 40 days at least. You can go further out. Meanwhile, I do the 30-day thing is because I want to collect them monthly. I want to be like buying real estate and renting it. The biggest thing that I love about the stock market, guys, and you guys don't hear this enough, I don't think, and why I don't invest more into real estate is, guys, real estate makes the most millionaires, and insurance does every year. Those two things always do. But liquidity. Guys, I want to be liquid. If I think that the market's going to absolutely crash, I want to be able to get out of this thing, and that's what options is going to give you guys. And again, DKNG is just one of these. You can do these with Apple. You can do these with all these other ones as well. Let me pull up Apple real fast. You're just going to see this is all going to change here. I'm going to pop this up. And Apple is trading over here for $141.66. Say we bought 100 shares of it. And, you know, even if we bought, say we bought them at $150, $160 a share, basically. You know, I'm okay. Again, this is why I have these probabilities. And again, if you have, it's right up here where it says probability. And it's both on the calls and put side. You get the probability of in the money or out of the money. They're really usually within 1%, going to give you the same, because it's the same data that they're collecting pretty much. And I'm going to find something, probability of being in the money. Well, you know, if we go up 33 days out on Apple calls, you know, I can collect, well, a 10% one here. I can collect $60 for the month. And it's got to go to 160 for me to hit it. And am I okay with that? Yeah, because I bought it at 158 still. So I'm still making money per share as well on this. But this is how you're going to cash flow stocks, guys. This is something that I think a lot of people are missing with their portfolio. Guys, Warren Buffett didn't just compound his money all of a sudden dramatically. How do you think he produces income and everything? Is it dividends? Yes, he loves dividends. But he's also selling options in order to give himself that extra money. Because people are buying these options, guys. Don't act like, if you are watching this channel, don't act like you've never tried to buy or sell an option.
and try to make 100% overnight or something like that. I've done it. I mean, we've all had those YOLO plays, is what they call them, or gambling plays, basically the same thing, where, oh, well, I'm going to try to buy it, and I'm going to try to make this much off of it. Well, it's not smart. If you're looking at it, you can go to this tool right here, and it's the most amazing thing that I absolutely love this over here on it. And then, maybe you want to do this weekly. Maybe you need to get paid weekly on it, 5 days out. Go find what you want to sell. Maybe you want to sell it for $130. Guys, you got to remember where it's at. And say you're bullish every week on it, or whatever the case may be. You just got to figure out where exactly. Nope, we don't want to do that. Figure out exactly where you're going with it and sell that play to it. So I think, right now, Apple's probably going to continue to go up. I'm going to sell a put. I could be wrong, but the market seems to be trying to bounce back. And I'm only going to give it a week anyway. So I can collect $10 a week, which is less than what we would have got for the monthly. So remember that. You're taking a little bit off, but you're also taking that time off as well. Maybe $131, you're getting $20 a week. 20, 40, 60. You actually are going to end up being better off than collecting the $61 for the monthly. But you're adding more risk here. You got a 6.92% chance of going in the money here if you're reading that. So learn the numbers, play with Thinkorswim, guys. You don't have to trade on Thinkorswim. Open an account, put $10 in there, or put $100 in there to buy shares or whatever you want to do. I've seen people put $1 in there, guys. Fund it with something so they get real-time data and everything like I have, and then just use the platform as a tool. And then trade on Robinhood. And I'm not saying trade, but sell covered calls on there. Get something going, guys. But thank you guys all for watching. I hope this helps somebody.